obviously give you an overview of the global and Asian market and then drill down into the local market. We've got Henry Chin, who's our new Asia Pacific Head of Research. That'll be followed by Stephen McNabb, who's Head of the Australian Research Business. And then we'll have a panel. We've got our key national leaders. The moderator will be Ari Petrovs, our own Karl Stefanovic, and that'll be led by Andrew Tracy, who heads up our Office Services business, Chris Hines, who's the new leader in our GCS business, Josh Cullen, as you know, heads up our Capital Markets business, Matt Haddon runs our Industrial business, Neil Proudlove, our Retail Investment Sales, and David Milton, our Residential business.
To start with, we want to talk about what our investors are thinking in terms of real estate investment. CBRE, we conducted a global investor intention survey. We collect more than 600 respondents globally, try to ask them what you're thinking, what you want to invest, where do you want to invest. I draw some key charts for you to take away, some might be relevant for you guys in Australia. To start with, the first chart, it's so many greens, I cannot describe the greens here. And then what I'm going to tell you is the key messages are here. Across the globe, every single investors across all three regions, they want to put more money into real estate in 2014 compared to 2013. We also ask the investors, which cities do you want to invest when it comes to the cross-border investment on the global levels? You can see in Asia Pacific, number 1 is Sydney. Number 2 is Tokyo. So mature market comes number 1, number 2. And for European markets, London is a clear winner. Nearly a third of global investors, when they come to Europe, they want to invest in London.
So my role today is really just to take you a bit closer to what's happening in the Australian markets. I'll do that from a few perspectives. We'll start with some of the big picture drivers and look at what's changing in terms of capital flows and some of the macroeconomic indicators. We'll then drill into the commercial sector drivers, so what's driving occupiers across the three main commercial sectors. And then we'll end on our favourite topic, what's the investment market outlook over the next 12 to 18 months. So if we look at big picture drivers, I think the key point here is in terms of the economy, things are really panning out as we discussed 12 months ago. There's been a gradual underlying trend improvement in growth driven by the consumer and housing sectors. There are some clear headwinds to growth though. Business investment is running off largely due to infrastructure spend, which is having an impact on markets in Western Australia and Queensland, probably more so than over in the East Coast. We do have strong export growth, and in fact the very strong Q1 GDP number was driven by an exceptionally strong export growth outcome. I think the key message here though is that the economy in underlying terms is still below trend, and we wouldn't be surprised to see GDP dip below that sort of 3.25% level in the next 6 months. But overall, the trend, as the yellow line indicates, is an improvement. It's not a boom time, but it's a gradual improvement. I mentioned that the mix of growth has changed across the states, principally because of the mix of growth. Infrastructure spend runoff is dragging down demand conditions in Queensland and Western Australia. So you actually have a demand recession in those states. This number excludes exports, so those states benefit in the long term from the export growth, but in the shorter term, that demand runoff is impacting those markets. And you can see, for a change, New South Wales is now leading the nation in terms of growth with over 4% growth in demand. Again, consumer and housing have been critical to that. So what we're really seeing in terms of the impact this would have on commercial markets is a change in our expectations for where we'd expect demand to emerge first and where we'd expect a demand to emerge earlier over the next 12 months. Shifting more to the East Coast. The equity inflow story and the investment inflow story for property that we've seen is very much part of this overall economy-wide trend, where we've seen an increase in direct investment, a shift to equity investment, and less debt being used to fund balance sheets. So it's not surprising, this one we show quite often, and we saw this last year. The net balance sheet position of foreign investors has continued to increase. So Australia has been attractive to foreign investors on a number of fronts, and properties looked attractive relative to other markets within the region and other markets globally. We saw the net exposure increase by $16 billion between 2007 and 2014, and by about $4 billion last year. So that trend hasn't really slowed down yet. I think the story is, and based on Henry's story earlier, as the rest of the world does improve, which looks like it's more like 2 to 3 years away, some of those flows may look elsewhere. So this story really stays intact, at least over the next 12 to 18 months, I think, that Australia still looks pretty good, and Australian assets as a whole are reasonably attractive to foreign investors. So in summary, demand conditions or indicators generally improving across all sectors. Supply is an issue in some office markets, but as demand improves, it's less of an issue for retail or industrial. Industrial's the tale of two sectors though, and it's probably a tale of where you're located as well. Adelaide North would be a market which would be more exposed to the manufacturing element. So look for core logistics exposures. They're well placed to benefit from the recovery and from growth. Rent growth, stable in office, but improving in the other sectors with the cycle. And so the investment outlook, just to reiterate in a very bright colour, rent growth and yields for the cyclical sectors improve, and that supports the yield performance, whereas office yields are currently looking more balanced.
Over the next short period, we're going to talk to these panellists about what's actually happening in the marketplace and give some practical advice. We might start with you, Matt Haddon. It would appear that you are the best in show potential sector, according to Henry. But we might start at the macro level in regard to New South Wales. For the first time in a long time, we're hearing that there might be some infrastructure investment in this state.
Yeah, sure, Ari. I don't think there's any secret that industrial occupiers are drawn to infrastructure, and infrastructure projects have really driven what's been going on down south. So I think the New South Wales State Government announcement of the Badgerys Creek Airport, and in fact the whole Western economic development area is going to have a major impact. It's going to create the next Eastern Creek wave of industrial opportunities.
Okay, moving on to the office sector. Andrew Tracy, you've had the reins of the office business in Pacific for just about 12 months now, so you're seeing a lot of what's been going on. Inquiry levels would appear to be better than last year, but what are you seeing? What's the characteristic of the current market with a focus on the Sydney market in particular?
Thanks, Ari. Look, I think that inquiry levels certainly around the country have certainly improved from 2013, and in Sydney that's certainly the case as well. But probably what's more important is that the levels of conversion rates are actually changing. So inquiry levels are a measure, but really what we're looking for is how many people are actually moving and making decisions to move. So there's more activity in the marketplace in terms of M&A activity. There's more activity in terms of just general takeovers and growth. So, 50% of the people we're now dealing with are talking about moving for growth rather than moving to relocate and downsize. So that's an important positive step with respect to the market.
Chris Hines, Andrew thinks that incentives have found their top. Have you decided to stop playing around with landlords, or what would you say?
Well, I guess I need to be a little careful looking at that audience, what I say there. But I think you're right, or Andrew's right. Incentives probably have peaked, but I wouldn't see that they're going to diminish anytime quickly. If you look at, and again, the comment about demand, there's no question that activity has improved this year, and I think it will continue in that same vein. But there's really three factors at play here. Firstly, it doesn't matter what the economic conditions are, leases expire and therefore they demand action. So you've got to do something. So we're seeing that in the natural course of events. But what we are also seeing is people bringing forward that decision, maybe 3, 4, maybe even 5 years ahead of lease expiry. That's probably a reasonably new thing and effectively being funded by the incentives in the marketplace and the ability of landlords to pick up those lease legacies. So we're in a sense bringing forward some demand. Secondly, as Andrew pointed out, we are seeing encouragingly a bit more economic activity and a few new players into the market that didn't exist, as Andrew said, 10 years ago. That's a positive sign, but I'd have to say that the overwhelming majority of people we're talking to still, the number one factor is cost savings.
Okay, thank you. Josh Cullen, last year we would have been sitting here saying something very similar about the market being fairly platinum hot in the investment space and a clamber to get our hand on core assets.
We're seeing it, the research points to it. Australia is now a mature and stable city. Our lack of core opportunities that's tightly held in the Sydney markets and core markets around the country, that's our big issue, getting hold of some core stock. But what we have seen from our recent campaigns is that cap rate compression coming right through. You know, CP3, Brisbane, 1 Charles Street, Parramatta, and recently 52 Martin Place. You know, they're all benchmark results in those markets. There is also the new capital flows coming down. I think 52 Martin Place had brought about 6 or 7 new capital groups into the Australian market. We expect them to continue to look down here for core opportunities, but not just also core. With that core opportunities being quite limited, they will start going up the risk curve, and we're starting to see that already. So the prediction going forward, core will continue to outperform, but we'll see those groups go into the A-grade stock and I guess the secondary stock and take on the risk for reward.
What are you seeing now and going forward in the depth of investor appetite to buy development sites and also the investors buying the product?
Well, firstly, we're not predicting an end to the market at the moment. It's been so strong, and there's a little bit of background in the residential market. We did some statistics on where we're at June 30 to last year's average on inquiry and sales and so on. We've seen inquiry this year. We were averaging about 1,800 inquiries a week on apartments. Last year it averaged about 1,500. For the first 6 months of this year we sold 1,600 apartments. Last year we'd sold 1,400 in the same time. One of the major differences is about the average sale price. This year average sale price has been $950,000. 18 months ago our average price was about $720,000. So significant increase in price point. And that's probably going to be one of the biggest effects in this market going forward, that where we've had quite explosive growth in price, affordability will start to affect the market where there won't be the same sort of growth, but we expect there'll be the same sort of underlying demand and take up for residential property.
What are you actually seeing in terms of deals based upon that consumer confidence?
We're lucky, New South Wales, particularly in terms of 5 or 6% growth. The first half of this year has been a really good start. Retailers are performing relatively well. Very few retailer defaults. Landlords are receiving rent roll. Very few vacancies. Vacancy rates are low. Tenant retention is good. So those are all the positives. Ability to unlock rental growth is quite difficult though, because retailers' occupancy costs are still quite high, margins are low. A lot of retail merchandise is being sold under sale conditions, so that's further diminishing their margins. But we've got a stable market and cash flow is good. Asset value growth is being driven not on the retail side, but on the cap rate firming. We're in a sweet spot in terms of retail at the moment, and I think that will continue for the next 6 to 12 months. The fear a few months ago was interest rate rises and whether that would slow consumer spending down. That's now been set out to next year, maybe Q2, Q3 next year. So I think at this point in time, particularly in terms of New South Wales, the market's pretty good.
So finally, I'd like to thank everybody again, and we look forward to working with you during the year and wish you all the best. Thank you.